Hello, everyone. Economic Ninja here. I hope you're doing well. You can't make this kind of stuff up. There are things happening all over the economy right now, imploding, and I want to go over a handful of news stories. Let me refresh this screen because I want to show you some charts. And we're going to start with conference board consumer confidence has been revised down again. There are so many ways that the mainstream media and certain people in the economy, they want to hide information from you. They do not want this information out. And also, I'm going to throw out, there's a lot of stuff happening with the channel all of a sudden with this Google attack and suppression happening. If you don't mind, I'm going to put a link down to my newsletter. It's free to sign up, and it keeps you abreast every day of all the videos I make, all the news coming out, and can make it in a really nice digestible format. It's free. It's down below if you wouldn't mind checking this out. Okay, conference board consumer confidence. It is a way of measuring how board members of companies, especially private, publicly traded companies, how they feel about the current economic environment and how they see the future. And if you'll notice right here, this chart is showing that we just hit a lower number. And what is happening is the Feds are trying to hide this information from you, because the more information that comes out that the economy is actually turning downward, and it's going to be a sharp downward turn. There's not going to be a soft landing. It causes you to do something about it. They don't want that. They want you spending money like a drunken sailor, like you're at the casino right now. They do not want you recessing right now. It says for the 8th month in the last 9, the headline conference board consumer confidence print was revised lower in June. The June revision from 100.4 to 97.8 then allowed the headline to beat in July at 103. So let's take a second and think about this. When the June numbers came out, it was at 97.8. All right. They revised it to 100, a drop of 100.4, so that when July's number came out at 100.3, it showed as a beat, like, oh, it's getting better, but it's actually getting much worse. This is not a joke. There is so much being hidden from you. It's incredible. And we're going to go through so many stories here about the economy, about the politics. As a matter of fact, I had an important meeting tonight, and I just found out that JD, the vice president, is going to be coming to where I live, doing a rally. And I think I'm going to head over there and start interviewing people and asking questions and answering questions for people. Type 10 if that would be something you'd be interested in watching live. I think I'm going to go do that today. I'm trying to jam through all of my work to get there, because people need to see what other people are hearing, what other people are seeing, because we are being so suppressed. It's absolutely insane, okay? I've never done anything like this. It's definitely getting me out of my comfort zone, but I think I'm going to head down there in a couple of hours. Now, it said again that June revision allowed the headline to beat in July. Notably, the present situation tumbled to its lowest level since April of 2021. Now, think about what was happening in April of 2021. We were seeing interest rates increasing. The Fed was now stepping in to go, okay, we're going to do something about this inflation thing. And board members around the country knew that this was not going to be good, that it was going to lead to slower sales for their company, right? Because as inflation worsens and interest rates go up, it makes a double squeeze on their customers. It says here, the overall trend in the labor market indicator remains weaker, meaning that labor job openings are lessening and unemployment is increasing. This is exactly what the Federal Reserve wanted. They want you unemployed. They want you scared. They want you coming to them for assistance and help. So now we're going to dive into some other stories here, and there's a handful of them I wanted to bring to you right now because it's so important that we get the bigger idea here. Now, it says U.S. home prices rose for the 15th straight month in May despite soaring rates. Now, I've been on record talking about this economic crash and the housing crash. I've explained exactly how it's going to happen, and it is happening exactly that way. What you have to understand, just like these numbers on the board, conference board consumer confidence was just changed, they have done that to the overall price of homes nationwide. The average sale price and the median sales price have both been changed on the St. Louis Fed's website. We saw a top come in the second half of 2022 at around $481,000 for, and they were both almost the same between median and average sale price, because the more homes that were selling than not were in that median range. That's why they were so close. And we saw them change that number down into the high 300s. They revised it down. Why? They don't want you knowing that nationally home prices have already fallen over 8%, okay? I have the proof. I've done many videos on it where I was showing the current stats, and then the Fed just said, you know what? Those aren't the right numbers. We pushed them down. So now it comes out like this one, US home prices rose for the 15th straight month. That is absolutely not true. They are messing with the data. Okay, you're gonna find out about it either now when you start digging into it yourself, you go watch these past videos, or you're gonna see it when it's in the headline media. I've shown you information from some very well-known insiders that I can't share because their jobs would be at risk, of Lennar and other builders, D.R. Horton, liquidating homes so low to funds, but they say, look, you have to record it at X price, and then we'll do a carryback in escrow for certain fees, essentially showing a 15% reduction in the price. But because of the way it's packaged in bundles of 100 homes at a time, you never figure that out because of the way they're recorded together with the county clerk's office. This is a real thing that's happening. Another way that you could see this is there are homes in my area in Nevada that a couple of years ago they were asking and they were selling for over $2 million, and now they're sitting at around 1.1, 1.2, and they're not selling. Thank you, Melissa, for the super chat. So here, the government data, and I'm telling you, they're lying to you. And it's really sad because a lot of these companies or these reporters, they actually go off of things like Case-Shiller, which runs a rolling 3-month average to like smooth things out. But before you know it, all of a sudden it's turning negative, and it actually turned negative 6 or 8 months prior. But because of that rolling average, you don't get to see it. It softens the blow. Okay, that's bad data. Another thing that a lot of these these reporters are going off of is Redfin, Zillow, and Realtor.com data. And I'm like, that's not real data. It's not. There's nobody looking it over, making sure it's true and concise. And these companies all thrive when you're buying or selling a home, right? I've already shown you the data where the amount of homes sold, total amount of homes sold in the year 2023 is almost to the number, the exact as all of 2008. And that was the bottom. That was the bottom in volume, okay? You have to look at volume when you're looking at real estate cycles, just like you have to look at share volume or crypto volume when you're assessing technical analysis in regards to returns going up or down in those share or crypto prices. Volume is so important, yet nobody talks about it. So it says here, giving the smoothing and the heavy lag in the Case-Shiller data, it's hard to find a causal relationship between prices and mortgage rates. But with rates remaining above 7%, it seems hard to believe prices can continue their advance. You know, it's funny. I asked my buddy today, he goes, you know, in his hometown in California, he goes, Travis, they're selling like crazy. I'm like, no, they're not. You do not understand. As a real estate agent, I could go down into the MLS, my local MLS, and go, all right, how many homes are listed in this city right now on this day? And then let me go back into history and look at how many were listed 10 years ago on the same day. And then you compare and you see that inventory is so light. Sure, you see a couple homes go on the market and sell really fast because there's a handful of people that are crazy and buying everything, not everything up, they're buying whatever they can because they're afraid. Those exact people were alive and well in the year 2006 and 2007. And then they lost their butts. As a matter of fact, we are seeing people right now buying homes a year and a half ago that cannot turn around and sell it if they intend to use a real estate agent, because just the real estate commission of 5% will take out all of their profit in the home. So they're already upside down if they try and sell. It's like somebody that buys a gold coin today and then, you know, for $100 over spot and then finds out the only thing they could sell it for the next day is $20 under spot. And they don't understand how the markets work. They don't understand time lag. These are big issues that people need to understand, right? So let's look at some more stories. Here we go. We are positioned for a financial and economic crisis. That's the title of the story. Now, I don't read any of these stories before I read them to you, but here we go. One of my favorite investors that I love reading and following, Harris Cooperman, this is out of Zero Hedge, has offered up his latest thoughts on the market and his funds positioning in his investor letter out this week. Harris is the founder of Patreon Capital, I can't even pronounce that word, a hedge fund focused on using macro trends to guide stock selection. Harris is one of my favorite follows, and I find his opinions, especially on macro and commodities, to be extremely resourceful. So check this out. Here's just a few segments from his letter. For a few brief moments this year, we have been betting against NVIDIA, with the exception of a handful of mega cap tech companies. Most equities have been rather range bound. Thank you so much, Stay Fitted, for the super chat. At the same time, many of our positions are range bound because their results haven't been extraordinary. Put simply, there hasn't been much of an inflection in the results yet. Sure, it's easy to complain that the market is distracted by AI and ignoring how cheap our names are. And that is absolutely correct. So many people, type 1 down in the comments if you agree. People are so infatuated and distracted by the term AI, they're losing track of what's really happening in the real economy. The same exact thing happened in the year 2020, 2021, I believe it was, when people were so infatuated with the term blockchain after Bitcoin had crashed down and then started taking off again. And they were actually publicly traded companies putting the name blockchain in their name and watching people go crazy, losing their mind buying their stock, even though their company had nothing to do with it. It's a prime example of people lose their mind and get distracted. To say that there are distractions right now in the economy, plus in the political arena, is an understatement. And that's why you have to be on guard for what's coming next. So here we go. This part of economic views and positioning. I'm increasingly of the view that the U.S. economy is slowing. How much it is allowed to slow before more fiscal and monetary stimulus are applied is hard to discern. However, it does appear to be slowing, particularly in sectors tied to the consumer. We've used this knowledge to reduce exposure across the board, just like Warren Buffett is doing. Some of these sales were very easy and obvious ones. If the consumer is slowing, sell consumer-facing products. Others were tougher sales, primarily businesses that we've owned for a number of years that have underperformed and become quite small in the portfolio. Large positions move our results, hopefully to the upside. Tiny positions are a distraction, and even when they work, they don't really impact our outcome of things. We've held a number of these for quite some time. They've slowly been diluted by performance and inflows. I feel that the time has come to jettison them. Even if I think they're perfectly good investments, I want to focus my energy on my best ideas. Besides, in an environment where the market primarily cares about companies large enough to be absorbed into passive indexes, again, that's another trend that we've seen, and it's been built up by a lot of these financial YouTubers that do not understand these indexes are vaporware. As a matter of fact, type 3 if you understand what I'm talking about. Indexes do not primarily hold the assets that they're representing. Instead, they're set up, they're a trading block or a way of moving money around, and they have insurance policies in case everything goes to crap tied to them, or derivatives. And so what happens with that is these indexes, all they do is trade the volume and follow the value either to the positive, the upside, or the downside of a basket of different assets. And they don't have to, they could just keep printing out these index shares, and they don't necessarily have to pick up the actual shares of the company. So this gets really scary when we're in a society that mostly is involved in index funds. And to talk about index funds, how many of you have checked the price of gold since January versus S&P index funds? Pretty impressive, right? When all of a sudden things start to turn around, and they turn around fast, all of a sudden you see things in a totally different aspect. And I think you're going to see a lot of index funds go completely just closing their doors, like or ETFs closing their doors because they can't hide it anymore, that they're not holding enough assets to deal with the sheer amount of buying or the selling thereof of those assets. One more thing I want to go over really quick. And we talked this morning about Buffett shutting down more of his Bank of America and how he's got to deal with selling slowly so he doesn't cause a panic. If you haven't seen that video, go check that out. This is it. Catastrophic jolts. Private sector job openings plunge to 6-year low as both hiring and quits crater. Says heading into today's jolts numbers, we were expecting much of the last month's unexpected job opening surge, which, as we noted last month, was the result of a bizarre spike in government openings to be revised away and for the June print to drop from the revised May print. In retrospect, that is what happened, if not to the extent we had expected, as shown it's shown a chart below. According to the BLS, or Bureau of Labor Statistics, in June, the total number of job openings did drop by 46,000 from an upward revised 8.2 million to 8.1 million, where the number of government workers was indeed revised lower. However, the ultimate drop was not as big as we see or the street had expected, as it printed the number, the consensus estimate of 8 million. The point of reading this is because these numbers are completely getting manipulated. Our GDP is not in negative territory right now because of the sheer amount of money the government has spent over the last few years to build warehouses, to build factories, and then some of our GDP numbers actually going to Ukraine. This is absolutely insane, where we're spending money in our country to build weapons to give them away to a country that we should not be helping out right now. I'm going to end it on this. Type 5 if you agree with that. We are failing in America. We are falling. Our consumer has it's shot. The consumer's done. They're tapped out. So I hope you're getting ready for this. I hope that you are getting inspired, because as much as you warn people about what's coming in the future or what you see coming and how they can move to protect themselves, most of them will not. And I don't want to see some greedy banks or just disgusting politicians in our government take over more of the banks, more of the wealth in our country when this crash happens. We need to band together. Look, I thank you so much for watching and hitting the subscribe button and hitting the likes. But what's really going to help is signing up for that newsletter, because it gives a daily consensus. Because so many people email me, and I know you email me, and I wish I could answer them all. I know you've been unsubscribed. I know you're not getting notifications. It's not me. All right, there's a reason, because they don't want the truth out. If you don't mind signing up for that newsletter, it's down below. It's free, and it just daily puts out a consensus of all the different, it's a nice package of all the different videos that come out, what's going on in the world, and some things that I can share there at times that I cannot share here on this platform. Hope you got something out of this. I think I'm going to go check out JD Vance's thing and bring it to you guys live if they'll let me in with cameras. Hope you have a great day. I guarantee you this. If they don't let me in, but they let CNN in, I will just do a live stream right outside of it, screaming and yelling. Hope you guys have a great day. Type 10 if you agree with that, and you'll watch that video. That'd be cool. I've never done a live stream or interviewed anyone, so it'll be weird. The Economic Ninja is out.